Hey, good morning, everyone. Welcome back to another chapter, chapter 15. That is our capital structure decisions, meaning how company finance to fund its investment or maybe buy back some of the shares. So, in this chapter, there are several theories. Those are very important. You can look back to the chapters or even PowerPoint slide. Then you will have some sorts of idea what the theory is all about. Say, going back to our theories in this PowerPoint slide. Okay, so there are several theories: theories, trade-off theories, signaling theories, pecking order theories. Altogether, we have four theories, and these theories actually some kind of statement or guideline how financial manager can finance, and considering the potential consequences of financing on the bottom line of the company. So theory, meaning Modigliani and Miller, these two researchers are actually proposed that when taxes are zero, corporate taxes, personal tax altogether zero, then no matter which way and how you finance to invest your um, any project, that's irrelevant to the valuation. And trade-off theory says no, we do not live in a world that has no tax. We live in a world that has tax, so we need to pay tax. I mean, from both sides, in corporate tax as well as personal tax. So, tax has some implication in the valuation of the firm. So it says, if there is tax, then you have some tax saving on your profit. But on the other hand, if you borrow too much, then you have to pay some cost, I mean bankruptcy cost. So bankruptcy cost and then benefit of tax saving, these should trade off, and this trade off will tell the company how much they should have borrowing, meaning how much they should have debt in their capital structure decision. If tax saving exceeds the potential cost of bankruptcy, then company should borrow more. If bankruptcy cost exceeds the potential benefit of tax saving, then company should not borrow anymore from that. And signaling theory, meaning when a company um, buy back some share, it actually gives some signal to the potential investors why company buying back some share, whether the company will have a better investment opportunity in the future or not. So that kind of signaling, and say company plan to buy back some shares, meaning company is going to do better and company is going to do good for the existing shareholders, for fewer number of shareholders. That's why company can buy back. Or company, when company going to issue new share, meaning company may not doing well, so the loss thing, I mean the bad part of the company, bad performance of the company now will be shared by so many shareholders. So existing shareholders will be experiencing little lower less than before. That's the idea. And pecking order, this is kind of importance, meaning we have several sources of borrowing. For example, debt is the first one. Then we can go to the I mean, the first one is the internal profit, second one is the debt. So if internal profit is not sufficient enough to fund your investment, then as a second choice go to the debt. If debt is not enough, then as a last resort go to the stock issuance. I mean, it's kind of ordering based on the importance, which one is the most easiest and low cost financing, take that one. So that's the idea. Okay, and based on this theory, we have several models and formulas to solve related capital structure financial problem. Let's move on for your Sunday's homework assignment. So this is our homeworks, and better be better. Okay, so to solve all of this problem, you just need to review some of the concept on break-even quantity, model with taxes, including corporation and personal tax, stock price after recapitalization, and capital structure analysis. Meaning, if you have some level of capital structure and you want to change it, so what would be the consequence of your changing capital structure on your stock price valuation? This sort of things you can review from these topics. Okay, let's move on to our problem one. So problem one, Chaplain Incorporation has fixed operating cost 500,000 and variable cost is $50 per unit. If it sells the product for $75 per unit, what is the break-even quantity? So if you go to the go to our formula sheet, then you can see QB, meaning break-even quantity equal fixed cost minus fixed cost divided by price minus variable cost. So can I just say problem one? What are the values we have? We have FC is 500,000. We have VC $50, not percentage, it would be in dollar term. 50, and then what else? Price equal 75, not percentage. 75, this is not percentage, this is number. Okay, so this is the value we have and we got it from our problem. Let me make them sorry, yellow color. I use yellow color. Okay, now what's the question? Break even quantity. So break even quantity, break even Q is what? So just use this formula, this one, F divided by P minus V. So this is our F, divide our P minus V. So this way 20,000 unit we need to product to get this break-even point, meaning no profit, no loss. Second, it says Wakaran Incorporation is unlevered and has a value of 400 billion dollars. And otherwise identical but levered firm finances 25% of its capital structure with debt at an 8% interest rate. No growth is expected. Assume the corporate tax rate is 25%. Use the model with corporate taxes to determine the value of the levered firm. So if we go to the more formula sheet, Modigliani theory with taxes. So corporate tax, theory, corporate tax, and this is corporate tax. So we can use this formula. Let's get the value. What will we have? Unlevered company value is almost 400 billion. 400 billion. And what else? Tax 25%. And what else? The capital stock debt is also 25%. Okay, using Modigliani. So this is our model. Taxes firm value. How we can get it? Equals value of unlevered firm. So value of unlevered firm, this one, plus TD, tax shield. So tax shield of debt. So how much is our debt? Remember, our debt is 25%. So this times this. Again, tax saving. How much is our tax saving? This should be tax saving and this should be 11. So this way we can get 420 billion dollars as the valuation of the firm. Okay. Problem 3. Cruise Corporation has 100 billion of debt outstanding, and otherwise identical firm has no debt, has a market value of 500 billion. Under a Miller model, what's Cruise's value if federal plus state corporate tax it is 28%, effective personal tax rate is 17%, and personal tax rate on debt is 29%. So let's see. So in this problem 3, actually we need to consider personal tax too. So Mila corporate and personal tax both. So this is our formula, and let's this one. Let's get the values from here. What's the value of unlevered firm? Value of unlevered firm 500 billion, and then corporate tax TC. Corporate tax rate is 28%. Then tax on personal saving, personal tax rate is 17%, and then tax on personal debt is 29%. So these are the values we have, and 100 billion share outstanding, meaning 100 billion of debt outstanding. So total debt equals 100 billion. This value we just get from our problem. Now if we say as a value from value, we just need to use this formula. So value of unlevered firm, that is uh, this is not percentage, sorry, this should be number. This is okay. Equals value of unlevered firm, value of unlevered firm. So value of unlevered firm is this plus bracket start, then 1 minus, again second bracket start, 1 minus TC, then 1 minus TS, divide 1 minus TD. Times D. Let me see if I have where I am making mistake. So this, and this should be an outside. Still, let me break it down. It has been messy. So I'm doing the first part only. 1 minus T C into 1 minus TC. So it should be 1 minus TC 1 minus TS. this, and then 1 minus TD, 1 minus TD. So basically I need to divide this by this. So now I can this divide by this. Now possibly it should work. Okay, so with just this part we just done this part. So hello unlimited value is this plus bracket start 1 minus this times that 515 million. So this is our answer. Now let's go problem 4. Problem 4. Lee Manufacturing's value of operations is equal to 900 million after recapitalization. The firm had no debt before the recap. Lee raised 300 million in new debt, used this to buy back stock. Lee had no short-term investments before or after the recap. After the recap, weight of debt was one third. The firm had 30 million shares before the recap. What's the price of the stock after recap? So price of the stock after recap. See price post, meaning after recap, how much would be the price of the stock? So value of new operation minus debt, old debt value, old debt its company had before recapitalization, and the number of share outstanding. We are solving problem 4. So VOP V value of operation is 900 million, and then old debt I don't know, old debt 0, because $300 million is the new debt, and the number of share outstanding, number of share, that's our 30 million. Now price post the share would be, if we use this formula, so value of operation new minus old debt. So value of operation is this minus old debt divide by 30. So $30, that's our stock price after recapitalization. And this yellow number you should change when you see different numbers on your problem. Okay, now problem 5. Problem 5, it says Die Tracking raised 150 million in new debt and used this to buy back stock. After the recap, Die's stock price is $7.50. If Die had 60 million shares of stock before the recap, how many shares does it have after the recap? Just makes sense. How much share the company buy back? So if uh, stock price is 750, stock price is 750, and new debt to buy back share is 150. This should be 750. Then how much share buyback? Share buyback would be this divided by this, so 20 million share. And now company had 60 million share before, so uh, should type here. Share 60 million. Can I just say, if this many share done, I mean it had before, minus 20 million share by bought, so remaining would be 40 million share. So you just need to put this on. Okay, problem 6. 6 is little long. Let's see. Shweta Satellites Incorporation produces satellites, Earth stations that sell $100,000 each. From fixed cost, F is 2 million. 50 Earth stations are produced solely this year. Profit total 500,000. The firm's asset, all equity finance, are 5 million. The firm estimates that it can change its production process, adding $4 million to assets and 500,000 to fixed operating cost. This change will reduce variable cost per unit by $10,000 and increase output by 20 units. However, the sales price on all units must be lowered to $95,000 to permit sales of the additional output. Equity is 16%. What is the incremental profit? Incremental profit meaning company has operation right now, and company is planning to add some dollar. It's investment project that will reduce its production cost, so that company can reduce its price, and then how much will be the new profit. The difference between old profit and then a new profit. That's our incremental profit. So let's try. The current situation, how much is our profit? Current situation, how much is our profit? Profit is 500,000. Then price of the product, price 100,000. Then Q, quantity of the production, 50 earth stations are produced, so it's 50. And then fixed cost, right now is $2 million. 2 million. So that's our current situation. If we say current, then what's our new situation, or I can say proposed change. So this is our value we can get from formula. Profit, we don't know how much would be the profit, so that's our question mark. Price would be how much? All unit price would be $95,000. So 95,000, and quantity, new quantity would be increased by 20. So 50, 50, uh, 50, say, plus this new 20. New Q, meaning quantity reduce, quantity increase, quantity plus. I'm making it different color so that you can add it. I am just making no color here because this is the formula output. Price done, quantity done, fixed cost would be how much? Fixed cost would be 500,000. 500,000. And how much is the new investment project? New investment cost 4 million. So this is our now input from the problem. Okay. So what's the incremental profit? So part one. Can you just say profit equals price gun price multiply q, then minus minus fc minus fc minus vc. Then how much would be our profit? I mean current situation. If this is the profit, so we see profit here. Say profit. If we play with this formula, then we can see like this. Oh, sorry, profit. We have profit already, so we just need to what balance we don't have. We have balance per P, we have balance per profit, we have balance per Q, FC, VC. So variable cost. So variable cost I can say like this. Yeah. So price times quantity minus fixed cost times variable cost. And we have profit is this much, and P minus this should be variable quantity, I mean quantity. P times Q. So P times Q. FC. FC is this and VQ. So FC is this and minus VQ. So it should be V times Q 50, like this. So last one. So if we send this to this side and this, then how much we can get? Okay, let me work on this formula again. Let's work this out. Profit equals P times Q, then minus FC minus P, sorry, minus V times the second line. Can I just say this is negative figure? So V times Q equals, this is down, then minus, sorry, minus down, and then this profit would be negative in right side. Okay, so if we just get it, price time quantity. So price times quantity fixed cost is this and profit is this. So altogether we will have this minus this minus this. And now if we say VQ, so we have Q equal 25. Okay, down down. Now V equals this times quantity. This 50,000. This 50,000 will be the variable cost. Okay. Now new profit after change is made. What would be our new profit if we change? Invest this much amount. New profit, say, would be price times quantity. So price times quantity, and the fixed cost is this, and then variable cost. This is our V. So this is our fixed cost, and this is our variable cost. So variable cost is this 50,000 units time. Quantity is this. So you can see this minus this minus this. Fixed cost would be our new plus old. So 650, and quantity, I mean, now quantity would be, variable cost would be reduced by 10,000. I need to VC reduction is 10,000. So this should be minus this. So purpose changed. Whatever we did is price times quantity, $95,000 price and 70 units quantity, and fixed cost, the new fixed cost plus old, that together 2.5 million, and then uh, variable cost would be $10,000 less. So this 50,000 minus 10,000, so times the quantity is 70. So this is our new profit. So how should we do incremental profit now? So incremental profit would be this minus our old profit is this. So 850. So as incremental profit, we got our incremental profit. Now here's the project's expected rate of return for the next year. So expected rate of return is incremental profit divided by investment. Expected rate of return. Estimated rate of return equals incremental profit by investment. So our incremental profit is this times investment is 4 million. So if we make it percentage, then we can see this. whether you should accept or reject, meaning firm should the firm make the investment or not. Of course, if the expected rate of return is higher than the cost of equity, this is 16%, we should accept this project, meaning should go for this project. And part two, would the firm's break-even point increase or decrease if it made the change? So this is part two. Say break-even hold, and we know break-even is this. F by P minus B. So old break-even. So our fixed cost is this, divide price, this minus quantity, this variable cost, sorry, quantity 40, and then break even new. What's our fixed cost? Would be this, divide price, price minus um, the variable cost. So variable cost would be again this minus this. $53 and the 49. Oh, again, this should be, or simply I can use this one, this one. So new break even, old break even, like this. And would the new situation expose the firm to more or less business risk than the old one? Actually, it is impossible to state unequivocally whether the new situation would have more or less business risk than the old one, because we need information on both the sales probability distribution and the uncertainty about variable input cost in order to make this determination. So, since a higher break-even point, other things held constant, is more risky, so percentage of fixed cost will be increased. So actually, it is impossible to state whether the new solution would have more or less business risk. Okay, let's move on to our problem 7. Problem 7, we have EBIT equals 6 million. 6 million. Growth rates, GL is 0%, and then cost of equity, RS, is 10%, 10%, and then shared outstanding 200, sorry, and then tax 25%. Okay, these are the values we can get from our problem. Now, what's the revolution intrinsic value of operations? Intrinsic value of operation. When growth rate is 0, then what's our intrinsic value of operation? Intrinsic value when growth rate is 0. Okay, look at this one. If G is 0, meaning growth rate is 0, then value of operation will be free cash flow divided by weighted average cost of capital. and NOPAT or NOPAT by weighted average cost of capital, or EBIT times 1 minus T divided by weighted average cost of capital. Now let's consider what's our weighted average cost of capital. Weighted average cost of capital, do we have formula over here or not? Yeah. So WD 1 minus T RD plus WS weighted of stock and divided by times by required rate of return or of stock. So we have unlevered, meaning this part weight of debt is 0. So we have only WS and uh, RS. So RS is 10 and weight is 1. So I can say this is just this. And now going to our formula, FCF. How you can get FCF? Value of operation EBIT times 1 minus tax rate divide this, not percentage, this is number. So this is the value. Then it says Rivoli is considering selling bonds and simultaneously repurchasing some of its stock. If it moves to capital structure with 30% debt based on the market values, its cost of equity RS will be 12% to reflect increased risk. Bonds can be sold at cost 7% based on the new capital structure. What's the new weighted average cost of capital? What's the levered value of the firm? What's the amount of debt? Yeah, we have some small parts in part 1. So what is its intrinsic stock price? So if we have help operation as this, then how many number of shares we have outstanding? Then it would be in SEC, value of stock would be this divided by this, and EPS. EPS is what? Do you have the formulas for EPS? Net income by number of shares. So net income is EBIT minus RD 1 minus T. So I can say EBIT minus interest rate is actually 0, and we need to estimate after tax. So it should be 1 minus tax. This 70, or 70 divide by number of shares. So this is our EPS. Now we can move to part 2. Now what's our WD? What's our RD? So WD is 30%. 30%. RD would be 7%. Then our uh, W stock would be how much? So 1 minus the remaining, and then uh, RS would be 12%, and tax is this. Then WSEC would be, if you go back to our cost of capital formula, this is so WD times 1 minus T, 1 minus tax rate times RD, this plus this times this. If we like this, so this would be, this is not dollar, this is actually number, or we can say 9.975% would be the weighted weighted average cost of capital. Now, what's the new weighted average cost of capital is this, what's the levered value of the firm, what's the amount of debt. So now value of operation, just same thing. FCF is how much? FCF is EBIT times 1 minus tax divide by this. So this is our value of operation after new capital structure change. You can make it percentage or whatever. Like this. And how much would be the debt? Debt, since we have 30% debt in our new capital structure, this times this. So this is our debt. Okay, now based on the new capital structure, how's the new stock price, how's the remaining number of shares, how's the new earnings per share. So first thing is stock price does not change if you buy back some share or not. So stock price would be exactly same, this one. This is what, part 3. Price after recapitalization. So value of new operation minus old, date old minus number of prior share outstanding. So value of new operation is this minus old share. We don't have any old share, or do we have? Yeah, old debt. No, we don't have any old debt because it was unlevered firm divided by number of share outstanding. So this would be our uh, this would be our stock price. Okay, then here's the remaining numbers of shares. So remaining numbers of share, just consider how much shares buy. Buyback. So this amount debt used divided by this. So this many shares actually buy bought. I mean buy back. Then how many shares remaining? So remaining shares would be how many shares we had before. This minus this 60, this 140,000 shares we have right now. Then or the new earnings per share. So new earnings per share would be new EPS would be our EBIT minus debt. I'm sorry, minus the interest amount. So if we have this much debt, and we need to multiply the interest rate, this times 1 minus tax rate is this much, and now we need to divide by this. So $3, no, EBIT bracket problem be this, no, EBIT minus, yeah, that makes sense. So this should be our price. EPS. Okay, done. Now let's get to problem 8. How long the video is going to be? Almost 1 hour. Okay. PD Printing Company has a total market value of $100 million, consisting of 1 million shares selling for $50 per share, 50 million of 10% perpetual bonds now selling at par. The company's EBIT is 13.24 million. Its taxes is 15%. Let's get those numbers. So WD and RD, RS, RD, EBIT tax, and then value. $100 million. 100 million. Weight of debt. Weight of debt. So weight of debt. 50 million. 50 million debt. So weight of debt. So this is uh, weight of debt would be okay. Actual number. Actual figure. Weight of 50 million. Then RD is 10%. Then RS definitely would be this minus this, and this would be SD. I mean RS, and this should be weight as weight S. Okay, then record date of return would be. Do you have it or not? $50 million, $50 per share. So 50 million. This EBIT is EBIT is how much? Cost of equity is should be the 14%, and EBIT is 1324. Tax is 15%. So this is the number we got from problem. So how much will be the weight? So this times this. This is our point 0.5 weight, and this is just right there, and this is also would be this times this 50%, and this is this, and this is actually percentage. Percentage. Yep. 100%. It is not taking up. Okay, that's fine. Okay, now what would be the uh, value of the operation? So value of the operation, first of all get we need to get the weighted average cost of capital. Weighted average cost of capital under current plan. So this times this plus this times this. This is our weighted average cost of capital is 12%. And if we say oh, we actually need to adjust the tax part. 1 minus tax rate. So this is our uh, cost weighted average cost of capital. Okay, now what's the value of operation? Operation would be FCF times 1 minus tax rate divide this 100 million. Now it says company is planning to change its capital structure, either increasing its debt to 70% or decreasing to 30%. And what would be the case next time? So say debt 30%, 70%, for example, 70%, then automatically equity will be 30%. But if debt changes to 30%, then cost of equity would be 12%. Oh, change here 12%, and then cost of equity would be 30%. So this would be the case if company use 70% debt. What if 30% debt? So 30% debt, then um, required rate of return would be 8%, 8, and cost of equity would be 13%. So this would be 100 million. So changes here. Just change here, you will get it. I think it has been a long. So still, if you face any problem, let me know. Thank you. Good luck.